Well, everyone, welcome to ARM 56, our risk financing course. This is the first night of the course, so we'll be covering our week 1, which will be covering the intro to the course as well as chapter 1. So again, thank you for everyone for joining us, and for those that will be listening to the recording, we'll cover that information as well so that you have some foundational information to start the course. So one thing I would like to thank are the sponsors for the course. The University of California, which I am employed. I'm the Director of Environment, Health, and Safety, as well as the Deputy Director for Enterprise Risk Management. As part of our program, we provide the course material to all UC employees for free, as well as the Golden Gate RIMS chapter has sponsored the course. And if you remember RIMS, they also provide sponsorship, Alliance Insurance Services, both their employees and clients. Bickmore, which is a risk consulting company, and Hermia, which is the Hispanic Insurance and Risk Management Association, had sponsored this, and I think we probably have about 30 or 40 people doing that. A couple of logistics I will answer as part of as we move forward here. As far as the couple introductions, obviously we're not going to have introductions of everyone, but a little background on me. As I mentioned, I work in the University of California. I've been with the university for about 3 years. I've actually taught the ARM course probably for the last 8, and so I've taught the ARM 50, the complete series 54 through 56, as well as ERM 57. Usually I said that I wouldn't be teaching the course until they changed the textbook. Well, they changed the textbook in October of last year, 2012, and so the whole entire series, ARM 54 through 56, has changed. Then they just announced this last month that ARM 57 is brand new as well, and so that's why these are new recordings that will be out there. As far as who you are out there, we have about actually about 150 participants. Quite a few from higher education, a lot of third-party administrators, hospitals, many state and local governments as far as risk pools, insurance, as well as consulting, manufacturing, and one of the unique ones is real estate that I have in there. Locations, pretty much everyone from the U.S., the continental U.S., as well as we have several folks that are from Alaska all the way to Maine. In prior courses, we've actually had people registered from Denmark as well as Morocco take the course as well. So a couple of items on here. For those that may not be able to hear, do you want to, it might be an item on your computer for that, but hopefully I believe everyone else can hear, but it looks like there's an item for those. Some folks may not be able to hear as well on their computers. The other question is about the books. And there a question about whether there's an electronic book you can buy for future classes or where you can write notes in. You actually want to purchase your book from the Insurance Institutes, or it's called the Institutes, .org. The book is $120 for the book. You have the option to buy the course guide and some other materials. Typically, I recommend only purchasing just the textbook. My experience is that's usually sufficient for most people, but it depends on your study habits and what will help you the most when it comes to that. You may be able to find the textbook on Amazon, since it's now been out for a year. It was the case a while back that some people couldn't find the textbook because it was so new, but I think that may have changed now. Just one moment. So as we go through as far as the course itself, the course schedule that we are looking at, obviously tonight we're doing introduction in chapter 1. Because of the holidays, so over the 10 weeks we're actually going over a longer period of time than normal, but this actually probably works out much better. In the last one we did 10 weeks straight, we didn't really have a week off. So we will actually be taking a break in between next week because Halloween, even though it's not a holiday, I know most people would rather spend that with their kids as well as part of that. That will also give people an opportunity to order the book if they haven't already, so that gives a little catch-up time. Then we'll go basically straight through. We'll have another break during Thanksgiving. as then the break after that will be near Christmas time, and then after that we'll pretty much go straight through. So essentially, in 10 weeks, we will be covering the entire 11 chapters. You'll notice for chapters 4 and 5 and 9 and 10, we'll be covering that as a group together. So part of that. So if there's any questions on the schedule, but for the most part, we try to space things out as part. Okay. So on the recordings, as I mentioned, for those who cannot attend live presentations, so if something comes up and you can't attend the class, that's not a problem. Usually I have the recordings up usually after, an hour after the class. So if something comes up a little bit later, or if there's, let me say, what World Series baseball game on or something like that, and that becomes more of a priority, I can certainly understand. So you can certainly have access to it. And once information will be sent out probably tomorrow morning, I mentioned you'll use your email to log in at the ARM study group to access the material, and I'll be sending a password out for everyone to be able to access that as well. All the material from the class will be posted on the website, and again, you can access at any point in time. So how do we make this work? So the best way, if you do have a course guide, also you can certainly use that. What I recommend is I will be sending out the slide deck usually at least a couple days before the class, and go ahead and print that off. I realized after I looked at what I sent out, and there's only one slide per page. In the future, there'll be 2 slides so that you don't kill so many trees, and then you can take your notes there. Questions, absolutely. I want to encourage questions, but at the same time, you know, when we try to structure it, and I may answer those at the end. I also recommend, if you have questions, to go ahead and just email those through a regular email, and I'll respond to the rest of the group. And so depending on if they're specific to you or if they're specific to the course, to make sure that's what's going on. Again, the goal is to cover all 10 chapters, or excuse me, 11 chapters in 10 weeks. So that's fairly aggressive. One of the things where people find a benefit is the course provides structure. And so where people have tried to study, they bought the book and they've had the book for a year, this will at least make them, you know, hopefully it will make you want to read it and move on with it. And again, the primary purpose of this class is to pass the national exam. I try to provide a lot of you know, stories and anecdotes that will help you and real-life examples. And so we'll be using things that are in the news that are relevant, so you can kind of see how those things tie in. Because ultimately it comes down to understanding the concepts and not getting into the weeds as I talk about the big picture. When you're studying the material, you'll see that we start off each chapter. We'll talk about the educational objectives as the first part of it. And then as well, then we'll also go into the terms and phrases. You'll have some of that in the text. A lot of times it's exhibits. What you'll probably hear me talk about quite a bit when we go through this is actually if you can explain the picture or the graph, that will help you be able to explain the concept, because the pictures and graphs a lot of times are representative of how do you understand those concepts, and if you can understand that, that really describes a lot of the text that's in there, and so that's part of the key piece of that. I do show Maria, you have a question. I'm going to go and unmute your line. Maria, you're unmuted. Okay. I'll go ahead and mute. Looks like sometimes people, so if you raise your hand, I'll mute your line, but I know some people sometimes have trouble, so I'm doing that. These are usually the first week glitches we run into when we do the class, and so as people learn the systems, we'll be moving forward with that. The chapter summary as well. You want to certainly, the chapter summary is important. Whatever's repeated in the summary, you certainly want to take a look at that. When you take the exam or look at the material, on the educational objectives, which we'll show in a moment, you want to have an answer for all the educational objectives. A lot of times the objective might be describe risk financing and its importance to the organization. That's the goal of the chapter. That's what they're trying to do, and that's the educational objectives for that, and that's what they're going to be testing you on. So that's where that's key. Again, all the exhibits. A lot of times for those that have worked in the industry, we might have our own lingo, or we have what we believe is a real-world answer. But when it comes to taking a test, whatever the answer is in the textbook. And so if there's 4 pre-loss and 6 post-loss goals, then so do you. So you want to make sure that you're not making new content or creating new examples. You want to use what's in there. Also, the test questions will frequently interchange information from different chapters. And so as we go through, it's important to understand the whole context of the text. As we go through, there'll be scenarios, and I'll talk about what some of those questions might look like in the future. The exam, for those that have not taken the other ones, it is a 75-question multiple choice exam, and you have 2 hours to complete it. What that means, what I always tell people, is that means you can miss 22 questions and still pass the exam. So when we talk about passing, you have to pass with 70%. And so the goal is, as much as I want you to have the information, the ultimate goal is you don't want to waste $185 or $90 and registering for the exam and not passing. We want to make sure that you do pass the exam. To register for the exam, when you call the institutes or you order your book, they'll set up an account, and that's how they basically track your progress. And that's also where you have to register for the exam. Depending on your location, you can either test at a ProMedic test center, which is most likely what most people will do. If you live in this area, in the Oakland area, we are also a approved on-site testing center, and so we can also have people test at our facility, and the fee is a little bit less if you are able to do that. But ProMedic charges $190 for that. And then there's the various testing windows, and I showed what that window is here. You'll notice that the pass ratio at this point for this most recent, for ARM56, is about a 71% pass ratio. ARM55 actually has probably the, I think it was a 74% pass ratio, and the new ARM54 is around the same, about 70%. So these are 54 and 56 are usually the toughest exams for people to be able to take. So one of the questions that does come up, as far as the book or when to purchase, because one of the things when you ask, it's going to say what's your testing window in which you're going to take the exam. The reason why they ask that before they show the book to be able to purchase it is that if the books change, like ERM57 is changing, they want to make sure that you're buying the proper book for the right test. It doesn't really matter when you order your book what you say your testing window is at this point, because the book's not going to change in between this time. And so go ahead and order, and then when you do your testing later on, then you pick your testing window. But I know that kind of throws people off, so go ahead and pick the testing window that's, if nothing else, in January to March, I think, is this one, and you'll be fine. And then you can order the books, and you want the 5602 is the item number, which will show as the first edition, I believe, for risk financing, or excuse me, 6th edition for risk financing will be the book that you'll want to order. The other question that someone, as far as taking the test, after each course it's recommended, so after you take 56, it's strongly recommended that you do take the exam at that point. Some people want to wait, they do 54, 50, they take all the courses and then they do it. I don't recommend that. Your mind will be mush. There's too much information to try to do that. So I would strongly recommend after you do 56 to go ahead and schedule the exam and take the exam right after that. And in order to get your ARM, you do need to pass all 3 exams. The Institute tracks the information. When you're done with all 3, they will send you a certificate and indicate that you can now use the ARM after your name as part of the designation. As far as someone asked about success in the study group, at least those, I get very positive feedback. Those that do take, at least on 54, those that took that most recently, out of the 20 people that told me that they took it, all but one had indicated that they had passed. And one of the reasons why at least the one person indicated they didn't pass was one of my recommendations is that when you look at the materials, to be at the 50,000-foot level. You need to be able to apply the information as much as there is things about memorizing certain aspects. The big thing you want to do is be able to get the big picture and apply those concepts, and then that will help you answer the questions on the exam. When we do the last class, we'll do a course review. We'll go over some sample questions and what will be covered as part of that, but that's really the gist of it. So at least all the emails I get for those people that do have taken the study group, they do find it very valuable. And as far as pass ratio, unfortunately, I can't track all 150 people. They have to let me know whether they pass or fail. And for the most part, at least those that have taken it have indicated they have passed. As far as once you do take the test, there are no notes. If you take it at a ProMedix testing center, it's almost like going through a TSA. You have to take everything out of your pockets. It goes in a cubby. You typically cannot bring your own calculator through the ProMedix testing center. They will actually provide you a calculator there. A scratch paper, depending on the testing center, they may give you a whiteboard to basically be able to scribble notes or scratch paper. You cannot take any type of notes or other information in there. Matter of fact, as a proctor for our facility, we do provide scratch paper. I'm required to collect that scratch paper afterwards and shred it or send it back to the institutes because they don't want people writing down the questions and then giving them to other people. So it is a very secure testing environment when you do take the test. So I think we answered most of those questions there. Okay. All right, moving on. So as we go through, we'll certainly be able to answer more questions, but now we're going to get to the meat of the subject, which is really Chapter 1 as we move forward here. So this is Introduction to Risk Financing. As I mentioned, each chapter will begin with stating the educational objectives so that people are familiar with that. And so for tonight's class, the good news is only about 4 educational objectives. It's a fairly short one compared to some of the others that we've seen in the past. So first one, we should be able to describe risk financing and its importance to an organization, describe common risk financing goals for organizations, as well as explain how to evaluate a risk in order to select a risk financing plan, and finally explain how enterprise risk management takes a holistic approach to managing risk. It's important, the reason I bring this up is that a lot of people ask when we get to later chapters about whether they need to calculate. If it says you'll need to be able to calculate a certain thing, that is part of the goals at that point that you'll have to actually do calculations. If it doesn't say calculations, then you're not going to be required to actually do those. 56 does not require really very much math, so that's a good news for those that have taken the prior courses. So when we talk about risk financing or risk treatment techniques and risk financing, the areas that we're focusing on tonight is that really the yellow section. And so when we talk about risk financing, there's really 2 options that we have. We can either transfer the risk, which is typically considered that we're buying insurance, or sometimes through contracts we can transfer, or we're going to retain the risk. And so those are really the 2 options that we're going to have when we talk about risk financing in the global, from the global standpoint. What's important from this, as I mentioned, it's important when anytime there's a graph or type of picture is to be able to explain, if you look on the left-hand side, those things that are in white, those are risk treatment techniques. That's what was covered in ARM 55. And the certain things we can do is we can avoid the risk, not take on that action, or we can modify the likelihood or impact of the risk, which is risk control, or to different, prevent the injuries or provide certain type of equipment, things like that might be part of it, or building construction might be part of the risk control aspect, like sprinklers, those things. And then the other one you'll notice down there for risk treatment is you can exploit the risk. And that means, which is different when we think about the new world of risk management, is that there's certain things that we want to take advantage of, certain situations to where we can actually make a profit. And so that's really what it means by exploiting a certain type of risk. So on the other side is the risk financing, as we mentioned. The 2 methods are transfer the risk and retain the risk. And that's really what this whole book is about, are those 2 elements. And as we go into the later chapters, we'll talk about captives, self-insurance, risk retention groups, derivatives. So there's a lot of different ways that we can risk finance, and so that's going to be the bread and butter of most of the rest of the chapters as we move forward. From a definition standpoint, when we talk about risk financing, is a conscious act or decision to act that generates funds to pay for losses or offset the variability in cash flows. So this is a definition. This is one thing you want to make sure that you do know what specifically risk financing is. So when you think about a conscious act or decision to act that generates funds, risk financing is nothing more than setting aside money with the anticipation that you're going to have a loss. The way we view our insurance programs is we call them funds for failure. Essentially, if you think of it that way, what our expectation is that we're setting aside money, so it's a conscious act that we're going to generate funds or set aside funds, at least in our case, to pay for the losses. When you buy insurance, essentially what you're doing is you are paying an insurance company for them to take on the risk, in which what happens is if you have a loss, they will be the one generating the funds to then pay for the loss. This has nothing to do when we talk about risk control. We're not minimizing the risk. We're just transferring. We're paying for the loss. That's all that we're doing when we talk about it. The other risk financing aspect, when we talk about offset the variability in cash flows, that goes into hedging or futures contracts. So when you look at, I always bring up Southwest Airlines. Typically, is a very good example. A jet fuel. So you can basically hedge or buy a futures contract of jet fuel, and that will provide stability of what you're going to be paying over the next several years for jet fuel. And that way, you are now risk financing that portion of your operations of your program. It's primarily applied to hazard and financial risk. So when we think of hazard risks, those are accidental losses. So hazard risk results in a loss or no loss typically. And some of the techniques when we talk about hazard risk would be insurance-linked contracts. We might have internal funds or like a funded reserve type of program, as well as contracts might have a method that we can apply, that we can use that technique. Now, financial risks typically are speculative in nature. So if we're going to buy stocks or if we're going to buy futures contracts, there's a chance of loss, no loss, or there's a chance you can actually gain. So hedging techniques, futures, forwards, swaps, and options, well, those are the things we'll be talking about in the next chapters as we move ahead in here. So as you'll notice that what we're doing in this first chapter is really doing a preview of what we're going to be talking about in the next 10 chapters as we move forward here. So when we think about risk financing, there's really two risk financing techniques. There's transfer, which includes insurance and non-insurance techniques that shift the financial consequences of loss to another party. Then we say, okay, well, what's a non-insurance technique? Well, that's a contract, indemnification language, things like that. The other method, so when we talk about two risk financing techniques, there's transfer and retention. So the second, retention, is the idea of absorbing loss by generating funds within an organization to pay for loss. So when you think about retaining risk, what that means is you're self-insured. You're self-insuring a portion, or even if you have a high deductible program, as we'll talk about later, that you're using your own funds to pay for those type of losses. So you're retaining your risk. In the later chapters, we'll talk about a funded or unfunded reserves, and there's different ways you can retain your losses. And this just depends on what your risk appetite is, as we talk about those type of things later on in the chapters as well. Hazard risks typically are going to require both retention and transfer. So when we talk about retention and transfer, almost everyone is going to have a program, even university. I'll do as an example, our workers' comp program, we have a self-insured retention of $5 million. Huge retention. But we also have, so that means at some point we have an attachment point, anything past $5 million, we are now transferring that risk to an excess carrier. So if we have a catastrophic loss, we still have coverage. So really, when you think about any type of insurance program, no one is fully retaining everything. It's very rare that that might happen, but usually there's going to be some both retention and transfer in any type of risk financing program. More specifically, if we think about risk transfer, what does that include? Well, insurance, I think most people recognize insurance as a technique, and that transfers a potential financial consequence of a specified loss exposure from the insured to the insured. And so insurance is certainly a mechanism to do that. Now, it may also include services such as claim handling and defense costs. So when we think about a specified loss exposure, well, just like if you have property insurance, you have auto insurance, that's a specified loss exposure, and so it's very specific on what we're actually transferring when you buy that insurance. If you have umbrella coverage, that's going to cover more things, but it's going to be specified in what the contract of that insurance basically has or the form. We also have another transfer technique, which is contracts, and this is a form of non-insurance risk transfer. And really, when you look at that, it's hold harmless or indemnity agreements. And I would argue that this is probably one of the biggest areas that we see the most growth of transfer techniques. Is everyone through contracts is trying to get through contracts, everyone's trying to push more risk onto someone else. And so if you look at a contract, what they call mutually beneficial contracts, essentially says that each party is going to take on a certain risk of negligence, or if there's certain types of things of what they're going to indemnify from another party. And within a contract, they're usually specified that another party will indemnify and hold harmless that if something happens. So if you have a contractor working on your property, you have a contract that if anything happens that they do that causes injury to maybe a visitor to our campuses, that someone may still sue the university, but through that hold harmless and indemnity agreement, they'll essentially pay the defense costs and they'll handle the claim and pay for any losses. So that way we are, we're held harmless, as the term implies. Hedging is the other risk transfer technique, which is a financial transaction in which one asset is held to offset the risk associated with another asset. Again, hedging, when you think about it, it's I'll have a contract essentially for jet fuel, and the idea that if prices go up, I'm not necessarily going to lose money, but I lost an opportunity to, or excuse me, prices go down, let's say on jet fuel, I lost the opportunity to make more money, but at least I got stability. But if prices go up, I actually gain compared to everyone else. And so the contract is really the asset that you're holding on to, and at what point you can use that contract to purchase those assets. And basically that's what a futures contract is, exactly the same type of thing. It's an exchange, a trade agreement to buy or sell commodity or security at a future date at a price that is fixed at the time of the agreement. So futures contracts and hedging are really the same thing, just how you want to use the various wording for it. When we talk about risk retention, risk retention indicates the most economical risk financing technique available. If you're to talk to any risk manager, the goal is to retain as much risk as you can. Ultimately, depending on the size of the organization, the larger you are, you want to losses become more predictable. And so instead of paying an insurance company to transfer the risk, the idea is that, let's say for an auto claim, this will I think make most sense on the next slide, or the next bullet point, which talks about mainly used for predictable, frequent, low severity loss exposures. Most organizations will have a certain, they know what their fleet size is, they have a certain size, number of auto losses, and they'll say, we know for the last 5 years we paid, on average, let's say, $50,000 in auto claims. And so with an actuary, they can make a determination. We're going to say we're going to self-insure up to the 50,000 point, and because we know we can take this many losses. What the benefit is there is when you think about when you buy an insurance policy, is you're trading. It's basically the insurance company's going to Vegas, and what you're betting is, or what they're saying is, they may charge you $75,000 for the insurance, knowing that you only have $50,000 losses, assuming that you're going to have the same exposure base. So they make $25,000. What they also make on that is the money they collected, that $75,000, is they're going to invest that as well and make money off the investments. Now, while that was really good during the stock market boom, and that's where most insurance companies were making very good money, and so that's where we saw a lot of the profit making was actually in the interest income that was generated off of that. Well, if you retain risk, you're basically doing the same thing. Instead of paying $75,000, you're saying, I'm going to set aside this $50,000 in the funded reserve, and now I'm also going to invest it, and I'm going to make the interest. And so now, not only did I save $50,000, if I had less losses, I directly benefit much more immediately from it. So if I institute better risk control techniques, and we only have $25,000 in losses, I just essentially made, money off of those techniques by putting them into place. Now, sometimes there are some exposures that cannot be insured or otherwise transferred, and so they'll become too costly. An example typically of that is terrorism coverage. Depending on the type of organization, you may not be able to obtain that, or it's just priced, or actually in California, a good example is earthquake coverage, that you cannot, not adequately priced, and depending on the type of level that you can get, or because it's excluded on homeowners coverage, you have to buy a separate policy specifically to earthquake coverage, or in some states flooding. If you're in a floodplain, that coverage becomes more expensive. And what happens at that point in time, because there's no one willing, there's no insurance companies willing to do it, typically the government steps in and then provides some type of risk pool, which allows that to essentially happen. So anyways, I think when we talk about risk retention, as we go through the chapters, one of the things you're going to find is we talk about captives and risk retention groups. Each one of these things is the goal is to retain more risk, and that there are different vehicles to do that. The least effective method is the first dollar insurance coverage. It's the most costly, and it's good for small organizations, small mom and pop. But the larger the company gets, the organization, that's when why this 56 is so important, is to be able to recognize when you might be able to have higher deductibles or be able to retain more risk as we go through here. When we talk about, I mentioned planned retention or unplanned. So a planned retention is a deliberate decision to assume a loss exposure and financial consequence. And unplanned is just an inadvertent assumption of a loss exposure because it was not identified or accurately analyzed. So what would be an unplanned loss exposure? So if you didn't, maybe you didn't realize you had a certain type of operation that was going on because of how large you were, or all of a sudden, I like to use the example of carbon nanotubes in research. At this point, it's there's concern that carbon nanotubes will be like asbestos, where you're going to have asbestosis claims, and at some point, there's not really any coverage, or how we're going to handle that. So we may be retaining losses for a future claim because we don't know what the exposure is, or climate change at this point is being discussed as an unplanned exposure that we're not planning appropriately for retaining certain types of risk dealing with climate change exposure. So again, planned is basically you do a risk assessment and you say we need coverage for these things, or we're going to retain it, or at some point the unplanned is just it wasn't identified as a risk, and so all of a sudden you're basically paying for it out of that. When we talk about complete or partial retention, so a complete assumes the full cost of a loss would be complete, and everyone does a partial retention, and that kind of goes back to a high deductible program or self-insured retention. Is that most organizations, it depends on how big that retention is really what you're looking at when we talk complete or partial. And then finally, unfunded or unfunded retention. So a funded retention is similar to an escrow account, and for the university, we fund our self-insured programs. It sits in a trust account, which then will earn interest. And that way, if you think about it, you have liabilities on the books. We know what our losses are from our various programs, and that's a good way to go. Some organizations do unfunded, and it's a pay-as-you-go system. I would say most municipalities, cities and counties, and for that matter, private entities will do an unfunded. And what that means is that they're going to pay for claims out of their operating budget. And there's an assumption that there's a certain amount of profit that the company normally makes, and they'll be able to do that. The problem is if you're, let's say, affected by the government shutdown and your income stream goes away for some reason and you have some large losses, now you're going to have to find some other ways to pay for those. And so an unfunded mandate basically kind of depends on what your risk appetite is to do that. The other challenge from a funded standpoint as a government entity is that people would see this as opportunity. Here's where the debate goes, and this is the larger context that you might get a scenario on a question on the exam about, is when you set aside monies, there's opportunity cost that's being lost. You might be able to use that money for other purposes that could retain a higher interest rate or a new product line. And so from an operational standpoint, as a risk manager, the challenge is you have to argue the point that, look, if we have liabilities on the books that we know the actuary says we're going to have to pay for these claims, but they see this pot of money there and they go, well, we can buy a new building. We can do these other things with that money, and so they see it as an opportunity to use those type of funds. So that's the challenge that a risk manager has when we talk about funded or unfunded, is being able to explain that to senior leadership of what the benefits are, pros and cons to doing something like that are. There's also, when we talk about funding, you can pre-loss funding, which is money that's set aside in advance, so you have an escrow account. And this is what I was talking about. The disadvantage is money is tied up, and so you have an opportunity cost associated with that. You can do unfunded, which we talked about, which is current loss funding. Money to fund losses provided at the time of the loss, so you pay as you go, or immediately after the loss. And it's most commonly used because of low cost, but there may be not enough money in the budget to pay for losses, depending on the type of program you have. And then you have what's called unfunded post-loss funding, which basically means that because you don't have any money, now you have to borrow, or you have to raise capital. You have to sell a building, or maybe you have set aside a program, some ways that you can borrow money at a predetermined interest rate. So that would be an unfunded post-loss funding mechanism to do that. So we do have a question. So the question is, doesn't an insurance company force you to fund an escrow account? I wouldn't say, so the term escrow account, the insurance companies, if you're self-insured, they don't force you to do any of that because they don't have to pay anything until, depending on what the attachment point is. And we'll talk about that in later chapters. But the insurance company is required to actually set aside a certain amount of capital to pay for claims. And so that'll be part of it. So another question, are you able to use the funded money to buy a building or maybe pay for some of the losses? So if you have a funded reserve, these are actually great questions because this is the challenge that you get from operations standpoint, is that if you have a funded reserve, they see the money's there. As a risk manager, your job is to protect the assets of the funding. So if you do have a loss, you have money to pay for it. Because you could buy a building. It's not, I mean, the company can decide how much funding reserve. That maybe they say, we want to fund our liabilities at 50% or 75% confidence level. Or you could say, we're going to do 25%. The problem is that when those losses come payable, depending on how the payment stream goes, you may not have the money to do that, and then you have to take it from operations. So you can pay for the losses. I mean, you can do anything with the money when it sits there, and that's why the risk manager has to be able to explain why it's important, what those liabilities are. And that's why the actuary is so important to say, here's what future liabilities are when they do that. And the question is, isn't a letter of credit in effect in escrow? That would be an unfunded post-loss funding mechanism. So if you have a letter of credit, which you can use at a later point in time because you're not spending the money, I would consider that be an unfunded post-loss funding method. So because you're using borrowing to basically pay for the claim later. You know, when you think of an escrow account, that actually money is sitting aside there, whereas a letter of credit, you don't pay any interest or pay any monies until you actually use those dollars. So very good questions on all accounts there. So, okay. So some of the goals, and this goes right to the point that we've been kind of dancing around for the past couple slides here. The main goal is, of risk financing is to maximize market value by maximizing present value of expected future cash flows. Okay. So what does that mean? Is that whatever we set aside now, or whatever we're paying for, the money that we set aside, every workers' comp has a payout typically over, on average, about 4 to 5 years because of future medical, those type of things. You'll have payout schedules for general liability, auto. Those are typically 1 year and 2 years, you know, typically no more than 2 years generally. Medical malpractice or professional liability claims may take 10. Environmental claims typically last, you know, the payout might be 10 years or before you have a settlement. If you look at BP, you know, the BP, Deepwater Horizons, all the things that are associated with that, they're still paying and on those type of things. So they have a long line. So when we talk about the financing goals, again, maximize market value by maximizing present value, is what is a dollar worth now? Can we buy, what can we do with that dollar now to generate income? And that's where that opportunity cost comes in to stand into the equation. Also, managing the cost of risk involves minimizing the cost per unit of risk transferred and retaining risk when a sufficient return would result. So what does that mean when we talk about you know these big words of risk, the cost of risk involves minimizing the cost per unit of risk transferred. So how much per $100 of payroll. So a lot of times we think of an exposure base. How much insurance per square footage? That's what we're talking about, risk transfer. Because when you buy insurance coverage, it's based upon number of employees, it's based upon hours, it's going to be based on payroll, but it's based upon an exposure unit. And so the idea is that if you can retain risk, you can make a determination with an actuary that will be helpful to say, okay, we can retain this, and our dollar cost per unit is going to be cheaper by us retaining versus buying first dollar coverage, or doing a have a deductible of $1,000, maybe we move to $10,000, and that's the whole idea of when it talks about risk involves the cost per unit, is what's that sweet spot that's going to work for the organization. Also, finally, the return from retaining risk can be measured in terms of the savings and risk transfer cost. So when we talk about, if we had a policy that was $100,000, but we can retain, as I mentioned before, we can retain it, and we're only paying $50,000 a year because that's what our actual losses are. We just gained $50,000, and that would be a return by retaining the risk that we might be able to enjoy. But the other aspect is, can you sleep at night, knowing that depending on what type of program you've put in place. So on the text, for those that have it, this is one thing you want to take a look at. So we're going to be covering is Texas 1.7 to 1.9. So to achieve the financial goal of maximizing market value, most publicly traded organizations should pursue risk financing goals. Although their overall goals may differ, privately held non-for-profit companies should also do this. So there might be public organizations and the private and nonprofit. There's still this, these goals. But the common risk financing goals include these, and because it's a list, this is something that will be most likely a question on the exam. Is the most common risk financing goal would include pay for negative financial consequences of an event. You want to be able to maintain liquidity, manage uncertainty, and also comply with legal and regulatory requirements. So when we talk about legal and regulatory, well, you have to, workers' comp. Everyone's required to have workers' comp, so that would be a legal regulatory requirement. And also minimize the cost of risk, and we'll talk more about what does that cost of risk actually mean in terms of the larger picture here. So I'm just going to go over, when we talk about pay for the negative financial consequences of an event. So we have a loss. That's the primary goal, is to pay for the loss. So that's what that first one. When we talk about maintaining liquidity, and also I would say managing uncertainty, those two things come into line. When you buy insurance, or if you're risk retaining, is you're setting aside money. You know that you're going to be able to have money to do other things. It's predictable, and that's why the whole idea of uncertainty or insurance, it's all about probabilities. When you buy insurance, if you buy our first dollar coverage, it's $10,000. That's all you're going to have to pay for the rest of the year. Now next year you might get a big surprise because of increasing the premium because of your losses, but at least your total operating cost for insurance is X amount of dollars during that current year. And so that's why that's one of the goals to have is setting aside money when you set up your program. I mentioned legal, and then when we talk about cost of risk, a lot of times what you might hear more is TCOR, or total cost of risk. Unfortunately, most organizations, when they look at it, they just say, okay, we're buying this much of insurance, we're paying this much amount of dollars, and they view that as what their total cost of risk is. But it's really much more than that. So you have to include the administrative expenses. So your TPA, or third-party administrator, your claims administration, risk management consulting, insurance premium taxes, we'll talk more about. You have your loss control expenses. So that's what I do. So my cost of helping provide EH&S services to the campuses, so safety staff, fall protection equipment, all those things might be loss control expenses. We also have retained losses we have to consider. So different types of claims can have long tails on that, and then also we would have transfer costs. So we insurance premiums are part of that. So if we are buying insurance, that's what transfer costs are basically the premiums we're buying depending on what we're going to do. So when you look at TCOR, you actually, if you include all those things and you keep that, even if you do a higher deductible program, you're still measuring apples to apples. The problem is people just look, they only say, what's our insurance premiums, and they say, that's how much money we're saving, without realizing there's all these other things going on, and they may not be saving as much money. So that's where companies get into trouble. Risk manager can look really good and say, look, we got this policy and we saved $10,000, but you increased the deductible to $100,000, so now you may have larger losses because of that, and then you actually did worse because they're not counting what was retained in that. So it's important to include those retention costs that are part of that. When we look at selecting a risk financing plan of how you want to look at it, the frequency and severity characteristics of hazard losses have to be considered as part of that. In general, most large organizations experience a predictable amount of small losses. So from workers' comp, I can tell you, as a University of California with 200,000 employees, we have about 5,000 work comp claims a year. It's pretty much, maybe we have 100 more here, 100 less, but on average, that's what we've experienced over the last several years. So it's fairly predictable, at least in the frequency. The cost of those, because we know on average what our, historically what we pay, that can also be considered predictable. Auto claims are predictable. If you think about when people buy life insurance, there's actuarial tables that can determine, average lifespan, and that's where this comes into play, and that's why they can price, life insurance at $12 a month or whatever, because they have these tables that say if you're a smoker, your risk is higher, and they can predict essentially with using the law of large numbers what the characteristics of that loss might be. So when we talk about retaining, you want to try to predictable small losses, and what's small for one organization may not be small for another. That's what you want to retain. Catastrophic losses are low frequency but high severity unpredictable events, and those are really the most appropriate for transfer. Earthquake coverage, low frequency, doesn't happen, but if it does, can be very high cost. Flood, those are the things in which an organization really wants to buy insurance for those type of things that are very unpredictable, that don't happen that often. Medical malpractice claims for the university might be one of those. I'm trying to think of some other catastrophic type of losses, but typically, hurricane, Superstorm Sandy, all those type of things. Those are low frequency, high severity events in which really you're looking, that's what we consider to be excess coverage in many cases, that you might be looking at some of those type of programs. So the chart that's on 1.13 really helps kind of describe this. So as I mentioned earlier, if you can be able to describe what's going on in this, you're essentially, this chart right here explains when you want to retain losses and when you want to buy insurance. I mean, in one chart, you basically have a lot of information that makes a lot of sense. So we'll go over this a little bit more specifically. So when you look at what talks about low severity, that means low cost events. So high severity means high cost, and severity means exactly that. These are low dollar, and again, depending on the organization, low severity might be $10,000 for one organization, low severity might be $100,000 for another. It just depends on what the characteristics are of the organization. The loss frequency, or the uncertainty of level of risk. So if we have high uncertainty, the earthquakes, we don't know when an earthquake's going to occur, but when they do occur, they know high severity. It's that time that we want to buy insurance is going to be up here. If we have low uncertainty, meaning the event is predictable, that we have a pretty good idea, and there's low severity, we can probably retain a lot of those. So again, auto claims, we can say we've had these losses. We know that because we live in San Francisco Bay Area, we can predict these type of claims on a regular basis. We're going to retain those, or at least that would be the goal, is that's the things we want to retain. But when we get, and then in here, so this might be full retention, medium severity might be a little medium retention, a higher deductible program, and then this one is going to be probably real high, high deductible program because these events don't occur, and this is for that catastrophic coverage of, how many hits of a certain type of claim can we take on those. Ultimately, every insurance program is going to have a catastrophic kind of cap or attachment point. As I mentioned, for the university, we self-insure up to $5 million. So if we had a major loss that's above that, that's why we have the excess. We feel we can take several hits up into this point and retain those, and we have a planned, a funded, planned retention for those type of things. But if we had a major loss, then on that point, that's when our excess carrier will basically come in and will be able to pay for those claims. The Prouty approach is basically the same, shows the same type of thing. So a question came in back on catastrophic losses. Hurricanes and tornadoes have a predictable season. Are these categorized as low frequency event, or do they have a higher severity for certain regions? So this kind of goes, a very good question on this. They're low, I would say low frequency and high severity events that people will buy certain types of coverages. From an insurance standpoint, how you want to view this is that as an insurer, I'm only going to write so much coverage of earthquake coverage in California. I'm going to write so much coverage for flooding in another state. I want to diversify my risk. Because if I wrote all the policies in California, and that's all I wrote was for the Bay Area, and that's the only coverage I had, and I was State Farm, and we had a major loss, State Farm will go out of business. And so so what you'll find is that some insurance companies at some point will say, we're not going to write coverage in California anymore, and then they're going to write coverage, they're going to take on the risk of the tornadoes. And then as we go in the later chapters, insurance companies buy reinsurance, which is in case they have, if they run out of money, then the reinsurance will pick up the claims beyond theirs. And so that's kind of a later discussion, but you know, and so coverage, you know, you can buy earthquake coverage in Montana. You probably don't need it. It's not going to cost you very much, but you can buy it because it's going to be low severity. You know, most likely the losses are going to be there. But if you live in those areas where there's hurricanes, or if you live near the coastline, you're going to be paying more for that coverage. Or insurance companies may not write the coverage, and then you're going to have to buy the government typically steps in, and then you buy flood insurance from FEMA, I think, or you can buy from the flood insurance program, and that's why you see those type of policies. Because essentially the insurance companies have indicated it's too risky for them to write it, and so they let the government step in. That's why TRIA, terrorism coverage, is the insurance companies, even though it's backed by the federal government, they have determined that it's too risky for them, and they basically don't write the coverage, and it's available, and that becomes a challenge for other organizations. The Prouty approach is basically it's another depiction of what we saw on the past slide, and the idea is when you look at loss severity, severe, significant, or slight. So if we have a low cost and the loss frequency very rarely happens, we probably want to retain those type of claims. We'll retain, and then the decision is, I would argue that you're always going to also try to prevent most things, but maybe in some cases, let's say it's a box cutter, or let's say actually almost nil and the injury is slight. Okay, that's a paper cut. Okay, we get paper cuts. Are we going to put on a whole bunch of risk control techniques for paper cuts? When we're just going to retain it, we'll pay for the first aid, and that's what we'll do there. When we get into here, where it's definite, so this would be workers' comp. We know we're going to have work comp claims. So the loss severity might be slight, but they most likely will happen, or you know, depending on the type of injury. I would probably say workers' comp probably fits more in the moderate category, being significant, and we're going to try to reduce or prevent that in most cases. When you have an event, which is way over here, where it says avoid, that means loss severity is really, really high, and it's always going to happen. So what would be something as an organization that you know that you're probably going to have losses on? Well, let's say you're a window washing company for high-rises. Okay, that's a risky area. If you have a loss, it's going to be pretty expensive, most likely. And you know, you can argue whether the loss frequency is, you know, probably not almost nil. I'd say it's probably slight to moderate. You might have, or roofing would probably be a better example. And so what happens is companies decide that if this is not their core business, they're going to avoid it, and they'll contract out the services. So that's why, rather than have our own people wash the windows and say, okay, let's have our custodians wash the windows, we're going to have someone else do it because we want someone that's specialized, and they will take on the reduction and prevention efforts because they'll be more skilled at doing that than we would be in trying to train people to take on those programs. But that's kind of where, so that's what this chart is basically trying to show is it's not, it's really looking at frequency and severity. This chart's looking at frequency and severity, whereas the past chart, the other chart was looking at severity and uncertainty. So there's kind of two different techniques you want to look at it. If you can explain both of these charts, you basically are explaining when do you want to take on risk, when you want to retain, and when you want to transfer. That's all these two slides are really showing, and that really is key to what we're really the foundation of this entire course is when do we take those on, and then what are the different techniques that we can use to do that. Then essentially here's another kind of, here's some of the different plans you might want to use for these type of things. So, so these are categories of risk financing, or these are the things that we will be talking about in the next couple chapters. There's informal retention. So what's an informal retention? If I'm a grocery store and someone says they got sick from eating the food or something like that, an informal retention might be, you know, here's a $25 gift certificate, and you know, a lot of times we don't have people sign a waiver or anything, but that would be, you're losing money, but you're basically, that's an informal retention. You paid for that loss, and you kind of call that go-away money or whatever to a certain extent. But that would be an informal retention as well. Self-insurance is much, that really is a formal retention. It would be self-insurance, and that's, essentially you're retaining most of the risk, so a self-insured program would be part of that. Transfer plans, when we talk about transfer, that's a guaranteed cost insurance, what we call first dollar coverage typically, or actually any insurance program, that if we're going to buy auto insurance, things like that, homeowners insurance, that's a guaranteed cost insurance, meaning that we pay, I pay $1,200 a year for homeowners insurance. If something happens, it's guaranteed cost that they will take care of, and they will, based upon what the policy says, will give me money to replace the value of my home or to rebuild my home. Insurance derivatives and insurance securitization. I'll leave that to discussion in the other chapters because it's not something that's easy to explain here, but the insurance derivatives, the credit default swaps, the mortgage industry, that's basically was a transfer plan to a certain extent that was used for that. And then finally, hybrid plans. A hybrid plan is a form of self-insurance as well as has a large deductible type of program, and we'll talk about the difference between self-insuring and a large deductible program as we go through the course here. There's retrospective rating plans, basically meaning that you have all your, it's structured in such a way that it's kind of like self-insurance, that you will, you know, at the end of the policy year, they'll go back and say you've had this many losses, and it has basically it's a capped program, but they take a look at what your actual experiences has been, and so the insurance company still makes profit in it. A captive insurance program are becoming more popular, and that's essentially a organization buying their own insurance company, for lack of a better term, or forming their own insurance company that's arm's length away, and that's what a captive insurance company is. And there's certain tax benefits associated with that. And then finally, there's pooling. And you see this pooling happens more with public entities. In California, you can now pool for self-insured workers' comp. And so in 2001, you started seeing a proliferation of self-insured workers' comp, private organizations that started to pool. And there are certain advantages of doing that. If you're too small of an organization to self-insure, pooling becomes an option that becomes much more affordable. And again, we'll be talking about that in the next couple chapters as well. On the financial risk side, when we talk about financial risk, it's speculative risk. So speculative risk, as the name implies, means there's a chance of loss or gain in this, whereas typically with hazard risk, you either loss or no loss, but with speculative risk, you can actually maybe make money. And in the past, I would say it used to be uninsurable, but now there's certain types of risk that can be insured. So when we think about speculative risk, commodity price risk, so would be an area that we might look at. So crude oil prices, would be an area that we might look at speculative risk of hedging. There's also financial market risk, so possibility of loss or gain through the value of financial instruments such as foreign exchange rates and securities. So there's, if you think about it, there's tons of ways that organizations can make money. Part of that is buying foreign dollars. Where they buy their resources, are they going to use U.S. dollars to buy, or if they're in China, are they going to, or other countries, are they, use, that foreign country's currency to buy the products. And then finally, there's interest rate risk, which is the chance of rise or fall of interest rates, which raises or lowers the organization's cost of borrowing. So all these things have to be taken into account when you look at financial risk. Now, where does interest rate risk come in, and why would we care as risk managers? Is that typically, if we're a public entity, such as a university, our investments are limited in what we can typically purchase. So from an interest rate standpoint, what bonds or different types of programs, we know what our payout schedule is going to be, let's say on workers' comp, and we're going to put a certain amount of dollars in there. Well, depending on how interest rates fluctuate, when we bought, whether long-term or short-term, the actuary sets aside and they say we're going to give a discount rate of 3% or 5%, what they believe you're going to make over that period of time. And if that doesn't come true, we may not have enough money to fund our programs. So interest rate risk does involve the risk manager, because a lot of times when you're dealing with large amounts of money, the interest rate will determine what you'll make off the investments that might be in your self-insured retention or your trust account that you're using to pay for claims. So when we talk about interest rate hedging, this is an example of what that might look like. So depending on when the loan is taken out, so this is the time the loan is taken, let's say, from 0 years, and we do something that's 30 years out or 5 years out. So when you hedge rate, what that means is basically we're going to say, we're going to set aside, no matter what, we're going to say this is 5%. But if the current rate goes above the hedged rate, meaning that we could earn more interest, now we lost the opportunity cost we lost here. But if it goes down this way, current rate below the hedged rate, we're not going to lose as much money. So what we're talking about again is stability. It's getting rid of the uncertainty is what we're trying to do when we're looking at financial risk, and why we may want to hedge an interest rate and say we want to pay either a certain price for the commodity or lock in an interest rate. If you think about this, what we're talking about interest rate hedging, your mortgage that you have for your house. That's a perfect example of what we're doing. You're locking in a rate, saying for the next 30 years, that says we want to do, whether you want to do fixed rate or adjustable. Well, I think my risk appetite, I want fixed, because and you're going to lock in that rate. And so over the next 30 years, I'm now going to pay 3.5%. Now, if the rates go down, I may have lost an opportunity to where I could refinance and try to do that. But some people take the gamble, and this is what a lot of people did with the mortgage meltdown. Essentially, is all these unique things was doing adjustable for the first 5 years, and then it locks in. Well, if you're not too confident and you didn't lock in, then you're going to pay this rate up here when you could have locked in. So mortgage. I mean, that's probably the best example is people's mortgages, what they're trying to do, fixed versus adjustable, and whether you can take advantage of interest rates going up or down at certain points, the ability to sell. And so some mortgages have a lock-in that you have to pay a penalty. Well, the reason why they put the penalty in there is because with the mortgage companies kind of taking the risk is that if you refinance after 6 months, they didn't gain what they expected to gain from that, and so they may have some type of penalty associated with it. So the last items we're going to be talking about before we end tonight's class is about managing risk holistically. And so over in the left-hand corner, you kind of see your enterprise risk management, which we talked about in ARM 54 extensively, but this might be the first introduction for those that are new to the course. Enterprise risk management is an approach to managing all of an organization's key business risks and opportunities with the intent of maximizing shareholder value. When we talk about holistic risk, and how do we, if you think about policies, one of the things that's happened with the insurance industry is they've actually siloed our approach to managing risk, because we say, okay, we're going to buy property coverage, we're going to buy workers' comp coverage, we're going to buy those type of things. But if you think about, if you have a loss, let's say it's an earthquake, you have property damage, then you have workers' comp, you have losses there, you might have general liability, you have all those things, but they're separate policies. And depending on what's in those individual policies, they may not work together quite as nicely as we'd like to see. And so the idea is when you think about enterprise risk management is how do all these pieces work together? The other aspect is the uninsurable risk. So we talked about that. Now when we talk about categories of risk, well, most everyone's familiar with hazard risk, which is the bottom down here, are those uncertainties associated with an organization's reduction of value resulting from the effects of accidental losses. So the last one, that's the world that traditional risk management has always lived in. But the reality is and I'll have to see if I can find the article to send it out, that an organization's, most operations, only 30% of an organization's risk is insurable. So when you think about that, where do most organizations lose money, or why do they go out of business? It's not because they had a huge loss. It's because typically they made bad decisions on strategic, operation, or financial risk. So what's a strategic risk? Are those uncertainties associated with the organization's overall long-term goals and management? Operational risk are those uncertainties associated with the organization's operations, and then financial risk are those uncertainties associated with the organization's financial activities. Well, the example I like to use is Kodak. So Kodak, when you think about why is it out of business because it lost, had a huge loss? No. It was strategic decisions that were made at some point to decide that they were going to stick to continuing the old way of kind of continuing their operations. So now most cameras, their bread and butter was film. Well, film is not where it's at. And instead of moving strategically saying we want to build the best camera and moving that way, I don't think you'll find Kodak cameras very much anymore. but Nikon and all those others. And now you think about, okay, smartphones are become our cameras that we typically use. An example of how you can optimize risk, I would say, would be Xerox. So Xerox is in the business of, at least they were, copy machines. Okay. Well, at some point, they strategically made the decision that what they do now is they're a document management company, right? So what their goal is now is to help people manage their documents and actually scan. So copy machines are really not copiers anymore. They're scanners in which you can now use those devices to manage your document and to sort them and send emails and those type of things. So Xerox's goal is now to try to get people not to use paper. So if you think about that, where you talk about Xerox, where the goal originally was, the bread and butter, what it was, strategically, they made a decision, their board of directors and operations, to move in a certain direction. So you look at why they're still around, it's because of the strategic risks that are associated with those decisions that you could not insure. You think about the operation. So operations, another good example from operational risks, cost-wise, let's use UPS for an example. One of the biggest cost drivers they have is fuel. Also the ability to deliver products in a timely manner. What they were able to identify is left turns cost them a lot of money. So now all the routes, for the most part, they try to eliminate all left turns as much as possible, and so the routes are predicated on basically doing right turns only. That, I forgot the amount of money, that there's a story that was done a while back, but they basically save probably $5 to $10 million a year just on fuel consumption because they're not waiting for red lights on left-hand turn lanes anymore. It also reduced the accidents because most accidents occur when making left-hand turns. So by looking at operational losses, operations, again, fuel consumption, that's not an insurable risk typically, and so it's an operational risk by identifying those. So the reason why I spent so much time on this is that it's important to understand when we talk about enterprise risk management, it goes way beyond just insurable risk. And I think when we have examples like that, hopefully you can kind of see what we're really trying to talk about. So when we key points, this is going to be something that'll most likely be on the exam of how ERM differs from traditional risk management. The key ways is ERM encompasses both hazard risk and business risk, whereas traditional risk management focuses really on just hazard risk. That's really the bread and butter. ERM seeks to enable an organization to fulfill its greatest productive potential, whereas traditional risk management seeks to restore an organization to its former pre-loss condition. So again, if you think about what insurance is, it's a fund for failure. It's to basically say you had a loss, here's some money, go build it again. It's trying to restore to what it was. It's not trying to optimize risk, which is really what ERM is trying to do. Greatest productive potential, that's risk optimization. ERM focuses on the value of the organization, whereas traditional risk management focuses on the value of the accidental losses. So this is one that people kind of miss if you think about it. When you think about the value of accidental losses, what that means is how many losses are we going to have? It's what the actuary predicts. That's what the hazard loss. It's a focus on how much is the building worth, rather than where the focus is on the value of the organization. What is the potential the organization can generate revenue? What are the opportunities in which you can do certain things? And then finally, ERM focuses on the organization as a whole. Therefore, traditional risk management is both its own discipline and part of the broader enterprise risk management discipline. Now, example on the other one, on ERM focuses on the value of the organization. I used this example at UC Davis. It's a good example. I like talking about the olive tree. So for those in other courses, they've heard this before, but essentially, those been to UC Davis, they have a lot of olive trees on the campus. And one of the challenges is you have, they essentially, will drop the fruit on the pathways, and then you have people on bikes, and they trip and fall, or they ride their bikes and fall. So it's a big cleanup effort every year where they have to do this. Well, traditionally, a lot of people would say, well, let's cut down the trees, let's remove the hazard. Okay, that might be one way, but then you get student protests and the other types of things that probably go with it. Well, the other alternative is you can look at how can we optimize that risk. Well, what can you do with olives? Well, you can make olive oil. And so that's where we actually have the President's Blend olive oil now because of that. So it's a way of looking at things differently. And that's really what ERM is looking at, is how can we turn something that may be considered a negative and optimize the risk. So when we talked about earlier about exploiting risk, that's a good example of how do you exploit a risk, is basically by doing exactly that. And on our last slide here, Enterprise risk management, when we look at possible outcomes, what this is trying to show on this is that, and it kind of goes back to the interest rate risk and hazard risk, is that traditionally we would say hazard risk, we're going to buy insurance. And if we're self-insured, we're going to look at that and we say, okay, no loss, that's good, and we might have a gain, which is good. Well, we can have a situation where we can have a loss, so we lost money, but then on the interest rate, because the interest rates of how we structured our self-insured program, we're losing money because that wasn't structured appropriately. Now we not only lost money because of the loss, but we also lost money because of how the money was allocated into the trust or set aside to earn interest. So the idea of enterprise risk management is looking at your insurance programs, looking at the operational risks and how these things tie together, that they can't be siloed and just be viewed as, I'm just buying insurance for this type of area. You need to look at reputational risk issues, financial, operational, all those type of things have to be viewed holistically. So let me see the screen. So someone indicated that okay. So hopefully the screen should be back to normal. Someone indicated the screen wasn't showing, but it looks like it is now. So on the last, actually we do have one last slide here. And one of the things I was going to show a demonstration, but one of the things that we've developed within UC is a lot of different tools of how we look at risk management and how do you consider enterprise risk management as part of the process. So this is during the years of budget reductions, a lot of times people would just look at things and say, well, you're trying to get to a certain dollar amount of how do we reduce losses. What we also recognize in doing this is that when let's say you cut a position or you eliminate a program, well, there might be some other things that you didn't consider. And so on the left-hand side, you'll see potential benefits. There might be benefits of doing some things. There might be, how do you, by cutting the position, maybe it impairs the mission of the organization. And ultimately, that's what enterprise risk management is about, is how do we remove the obstacles to achieving our objectives as part of that. You can have separate reputational risk, or you can even, if you eliminate, let's say you're a cashier and you say, we're going to eliminate the bookkeeper position. Well, it might save you money, but I think most people recognize that, well, now you have, there's a control activity that may be missing to where now theft can occur. And so separation of duties or control activities really become part of that discussion. And looks like one person's not having the screen's not working for them, but it should show up on the recording. So unfortunately, it looks like one person may be having problems with their screen out there. So apologies on that. So I will. There's a lot of tools that are out there, but the reason why I wanted to show at least some of these things down here, if you look at the steps, estimate financial severity losses, estimate the impact of each action on your ability to fulfill your mission. When you think about enterprise risk management, it's really encompassing all these activities. All the things we're talking about in here, when you look at budget reductions, are things you may not buy insurance for, but that's ultimately what enterprise risk management is about with that. So now the screen will probably be black. So that is the information for tonight. We went through all of Chapter 1. One of the things I will show here briefly, make sure it's going to show up here, is, so one of the things I sent out that you should see on the screen now is the activities. So these are question and answers that are part of the, as a sponsor, as a instructor that's sponsored by the Institute, so I'm allowed for copyright, we can certainly provide these to the students. This was part of the attachments that you received, and so as part of this, there'll be questions, and the first part will be the questions, and as I scroll down here, the second part, you'll see the answers. And so some of these things, they try to make it like Jeopardy. So the first one, the uncertainty about outcomes, some of which can be negative. So the answer is, what is risk, using the Jeopardy style. The next section has some true and false type questions as well. So these are helpful as you go through the material, to certainly to go as practice. The other thing I forgot to mention at the beginning, what I encourage you to do when you read the textbook is, for study habits to make it easier, is read the objectives in the beginning, see what those objectives, what it says you'd be focusing on, and then go read the summary before you read the middle of the chapter, because whatever is repeated in the summary was most likely the important stuff that you should be taking a look at, and then read the guts of the chapter, and that'll help you be able to study. The other thing as far as studying as you go forward with each one of these is I would say with each chapter you're probably going to spend about 4 to 5 hours per week is what I would set aside time for. So by the time you're done with all the chapters in the review, you're close to about 45 to 50 hours of study time altogether. And that includes spending time of the hour and a half that we spend doing the class. So with that, I will entertain any questions people may have. Otherwise, if there's none, then we'll go ahead and move. Next week we'll be covering, or excuse me, next week there will be no class. We'll reconvene the following week on the 7th, and I will be sending out a slide deck for that. In the meantime, I encourage those that are both online and listening to recordings, by all means, to certainly send me emails, and I'll certainly answer those questions and be able to help you out. So once again, thank you, everyone. I appreciate your participation and look forward to moving forward in the future. Looks like we do have one question here. Kelly, can you hear? Looks like a hand was raised, but it's not working. Okay. So again, thanks everyone, and have a great evening. We'll go ahead and end the recording, and look forward to hearing everyone in the next several weeks. Have a good night.